So it's made two big mistakes that I think are going to go down in the history books. One is mischaracterizing inflation as transitory. By that, they meant it is temporary, it's reversible, don't worry about it. That was mistake number one. And then mistake number two, when they finally recognized that inflation was persistent and high, they didn't act. They didn't act in a meaningful way. And as a result, we risk mistake number three, which is by not easing their foot off the accelerator last year, they are slamming on the brakes this year, which would tip us into recession. So yes, unfortunately, this will go down as a big policy error by the Federal Reserve.
In this video, renowned economist Mohamed El-Erian explains the future of the economy and the historical mistake made by the Fed, which will inevitably lead to a market crash. Make sure to watch this video till the end to find out what blunder the Fed has caused.
So the main source of this volatility is changing perceptions of the Federal Reserve. We are in this incredible situation, Major, where good news for the economy is bad news for the markets. And that's because the markets are worried that the Federal Reserve will tip us into recession by overreacting to strong economic news. So first, there's volatility and there's unsettling volatility. Volatility when things go up and down, and on the whole, you're better off over time. But that's not what we've had this year. We've had unsettling volatility because we've had the stock market down by anything from 20 to 30%. We've had bonds, which are supposed to safeguard your investment, also down by about 15%. So there's been nowhere to hide. That's why people feel insecure. That's why they look at their retirement plans with concern. The president is right. We are currently on what I think of as a bumpy journey to a better destination. And we need to navigate both the journey and get ready for the destination. There is a possibility that the Federal Reserve makes another mistake and that bumpy journey actually changes the destination. That's why the markets are on edge. So it's made two big mistakes that I think are going to go down in the history books. One is mischaracterizing inflation as transitory. By that, they meant it is temporary, it's reversible, don't worry about it. That was mistake number one. And then mistake number two, when they finally recognized that inflation was persistent and high, they didn't act. They didn't act in a meaningful way. And as a result, we risk mistake number three, which is by not easing their foot off the accelerator last year, they are slamming on the brakes this year, which would tip us into recession. So yes, unfortunately, this will go down as a big policy error by the Federal Reserve. Even Chair Powell has gone from looking for a soft landing to a softish landing to now talking about pain. And that is the problem. That is the cost of a Federal Reserve being late. Not only does it have to overcome inflation, but it has to restore its credibility. So yes, I fear that we risk a very high probability of a damaging recession that was totally avoidable. It does hurt the US, and we've seen oil prices go up above $90 a barrel. What does that mean? It means that inflation, which has been coming down, now risks going up again. So that is not good for us. However, that it came as a surprise, it didn't come as a surprise to me. OPEC is looking to protect oil prices in the context of declining global demand. All three major areas in the world, China, Europe, and the US, are slowing much faster, which means less demand for oil. So what does OPEC do? They cut back supply. So this shouldn't have come as a big surprise. That's what they do. That's their history, but it's certainly not good news for the US economy. Headline inflation will probably come down to about 8%, but core inflation, what measures the drivers of inflation and how broad they are, is still going up. So we still have an inflation issue. Inflation will come down, Major. The question is, does it come down with a slowdown in the economy or a major recession? That is the question that's being debated right now. It's not whether we'll have inflation coming down, we will, but it's the cost of that inflation coming down. We created 263,000 jobs. That's a lot for this stage. We also reduced the unemployment rate to 3.5%. That's really low. There was one concern, which is that labor force participation, how many people are in the labor force, came down. And that's not good news, and it talks to the importance of focusing on human capital. Growth is coming down. Inflation is still high. Unfortunately, it's not time to eliminate that term yet. This is going to be a different period coming up. It's going to be a period where there's going to be a lot more questions being raised, and I'm going to explain why that's the case. It's because of the neighborhood. I want you to think of a simple image that I'm going to use over and over again. You think you know your starting point. You think you know where you want to end up, but you have no idea about the journey that's going to take you there. Before the Ukraine war, that applied to longer-term issues. Climate change. We knew where we wanted to get to. We didn't quite know how we're going to deal with the transition issues. It had to do with battling future pandemics. How do you vaccinate the world? It had to do with supply chains resilience. It had to do with inequality. We knew our starting points weren't favorable. We knew we wanted to get somewhere better. We just didn't quite know how we're going to do that. And then along comes the Ukraine war. And the Ukraine war did two things. It moved the starting point backwards, and it's made the journey even more uncertain. Now, there's two ways of thinking about this. If you're a pessimist, and Nouriel will fit that category, it paralyzes you completely in terms of even going forward. If you're super optimist, you think, don't worry, it's going to solve itself. After all, it has in the past. I want to be somewhere in the middle. So the first thing that the Ukraine war has helped to do is completely change the distribution of potential outcomes for the global economy, and therefore the implications for both public markets and private markets. Part of that, of course, is this changing roles of central banks. In a high-growth, low-inflation world, in a high-growth, transitory inflation world, central banks are your BFF, your best friends forever. They will supply you with liquidity, and they will have the confidence to come in and curtail any volatility. In a high inflation world, that role can no longer be played by central banks. So there's a fundamental change going on in how central banks react with the financial markets. There's also fundamental social change going on, inequality. In this country, it's about the cost of living crisis, which hits the most vulnerable segments of the population particularly hard. In parts of Africa, it's about famine. Social considerations are going to become much more important in how policy making is done going forward. And we find it all very difficult to predict 4 risk factors in particular: interest rate risk, liquidity risk, credit risk, and market functioning / regulatory risk. So that's the world in which we're all functioning in. That's the world that public markets haven't been able to deal with well. You heard about the record sell-off in the safe havens at a time when you get a 20% plus loss on your risk assets in the public markets. And it's a world that alternatives are not going to be immune from. It's a world in which alternatives are going to have to think smarter in order to navigate.
Thanks for watching the video till the end. If you are still with us, then don't forget to subscribe and comment below what you think about Mohamed El-Erian's predictions about the future of the markets.